welcome back, guys, to another roundtable. My name is Adam. Victor beside
Juan.
me, Rusmin.
Hello.
Kenny.
Hello.
Thank you for joining us. You're the fifth person at this roundtable, and today we're going to talk about interest rates and how they can affect your stocks and your portfolio. All right. So there have been news reports coming out that the Fed plans to raise interest rates in 2023 because the economy is doing pretty well after COVID. Yeah, but some economists are saying they could be as early as 2022, which is just next year. All right. And then recently, I think there was a news article just last night that came up that said that inflation in the US is rising pretty fast. In June, the CPI went up 5.4%. So there are fears that the economy is heating up and then the Fed has to step in to kind of slow that down. So interest rates could go up pretty soon. But no one really knows. But what do you guys think? Do you think interest rates will go up in the next 1 or 2 years?
Yeah, I think chances are high that it will go up, right? It's just a matter of when. Okay, so that's why everybody's just guessing whether it's going to be 2022, it's going to be 2023. Okay, and if you look at the history, I actually plot out a chart on the interest rate correlation with US unemployment rate. Okay, because it's just a simple yardstick that I look at. Because once you have a full employment, generally economies are doing well. So there was a time where if you look at the charts over here, I mean, I have last 30 years, I will just look at the last 20 years to be short, to keep it short. And if you look at the chart over here in 2001, you can see that the Fed fund rate was actually above 6%. Okay, and at that time, the unemployment rate was just down at about below 4%. Okay, so generally, most people are employed in the US. And, as people start to lose their job in 2001 because of the September 11, right, the plane crash into the Wall Street centers, and then people started to lose their job. Businesses are not doing well. Interest rates started to drop again, all the way to as low as about 1%. I think in 2003. Okay, because unemployment rate was increasing every year. Okay, and things started to become better in 2004 all the way to 2007. The economy was doing well at that point of time, just before the Lehman Brothers collapse. Right, so there was a big bull run. And unemployment rate started to drop again, and interest rates shoot all-time high to about above 5%. Okay, and then Lehman Brothers collapse. That was in 2008. You can see that interest rates started to drop again. Unemployment rate again started to go up, okay, because economy is not doing well. Okay, and this leads all the way to 2016. The interest rate was at all-time low, very, very low, close to 0%, right? And unemployment rates continue to improve year on year. And I think just right before 2020, before COVID-19, when economies, every businesses was shut down, interest rate again dropped from 5% to 0% today. Okay.
So overall, there's like a correlation between unemployment in the US and the economy doing well and interest rates stepping in.
Yes.
And that's what the data has shown for the last 20 years.
Okay, so I think Fed will take in feedback like this. It depends on what data that they report in the US. If unemployment rates start to go up, start to go down again, they may start to raise the rate sooner, right? And they actually initially expect that the interest rate to go up in 2024. But this time around, I think they see the unemployment rate suddenly recover so fast. I mean, we have hit the highest unemployment rate in the US, above 15%. That was in the peak during of the COVID-19 to 2020. Right, but all of a sudden, I think 1 year later, now we are at 6% unemployment rate. It's recovered, much quicker than previous crisis during the Lehman Brothers collapse.
All right. So it's probably going to happen, right? So you guys have an idea. Do you think it's going to happen in the next 1 or 2 years?
It's definitely going to happen, but you don't know when.
You just don't know exactly when, right?
Yeah,
I think that's the question everyone's wondering.
Yeah.
No one can predict.
Yeah. So whether the interest rate will go on, honestly, I don't know, and I think it doesn't really matter that much as an investor. So one good example is, I remember back in 2018, they said they're going to signal 4 rate hikes. Yeah. And before you know it, the next thing, we have a trade war, right? Then after that, they decide to slash interest rate again. And then after that, we have COVID-19. They slash all the way down.
So I think the basically the lesson is you really cannot predict.
You cannot predict. Idea. And of course, I also never seen any big investor who made a lot of their wealth of predicting interest rates. And there's no correlation between interest rates and investment returns. So
I think just spend your time investing in great companies.
Just focus on the important things and not just the interest rate. So I think our takeaway at this point is that don't really care, don't worry too much about interest rates. And now the question is, even if interest rates rise, right, how would you react as an investor, right? I think that's the main thing. So I think first question would be, how will interest rates, affect the economy in general or your stocks in your portfolio? How does that affect them if interest rates go up?
So okay, so I will break them down into two categories. One is basically the financials and compounders. These are basically the ones that I focus on. So within the financials, we have insurance, we have banks, and then we have brokerages. So these are the companies that make money off something I call net interest income. So generally in the banks, what they do is they loan out for, let's say, for example, 3%, and they pay a depositor 0.5%, and they basically make the difference. So in here, I'm just going to give you an example of Interactive Brokers and why their interest rate does not correlate with the returns you get on the stock market, on their stock basically. So in here, you see Interactive Brokers, they basically in 2020, their revenue came down a little bit, right? Their net interest income make up about 60%, around 60% the last year, and it came down a bit, and then commission actually increased by quite a bit as well, because there's more volatility. People have their stimulus checks, they open accounts and they trade the meme stocks basically, right? Okay. Casinos are closed, that's one thing. And then you can see that this is also driven by the high VIX index. There's record client openings, right? It went from 690,000 to 1 million, right? That's an increase of 56% compared to last year. And then their client equity also went up by 66% to $288 billion. So in here, I want to show you the chart of their net interest income. You can see it has been quite volatile despite their client equity has been growing almost in a linear fashion. So with net interest income, they generate interest income from a few things. First is they loan securities to their own customers. Second, they do margin loans. And last but not least is the whatever cash balances they have in their account, they will sweep it into a government approved deposits and make a small percentage. So that will shift over time, and you can see that I plot their net interest income against the average federal funds rate. So you can see that when the average federal funds rate go down, their net interest income will go down. Mm-hmm. But what is most important when it comes to brokerages like that is that they continue to grow their accounts, they continue to grow their client equity. So overall, interest rates will go up and down, but on average, they will make more and more.
Okay, but for the interest income, basically, they make more interest income when interest rates go up.
Yes.
Just for that portion of their business, correct?
Yes. Yep. And because their net margin also will increase. So when interest rate go up, their spread will increase. So usually for this kind of companies, it's like when it comes to when they expect the interest rate to increase, they will always invest in short duration type of securities, so that when it increase, they are able to react quicker.
Okay, so that's for Interactive Brokers, and that's pretty much is the same for banks.
Yep.
Or financial institutions that kind of lend money. Interest rates go up, they kind of make the spread kind of increases for them, and they make more money for them.
Yep.
Even the same things for insurance, and they have the floats that they need to invest into those fixed income kind of assets. So that will also get affected, right? If there's interest rate were to drop, they'll earn low interest rate. If interest rate goes up, of course they'll earn more money. Okay, so financial type of companies typically will be affected by interest rate. They're quite sensitive to that.
Yeah, but I think the banks will definitely benefit much more than most of the people doing high interest rate, because when the interest rate are down, right, because the loans is very cheap, right, they increase, the volume of loans will increase because there's cheap money everywhere. So all these people will go and borrow, buy properties, buy whatever they want to buy, okay? And because they borrow, the loans are stuck for a few years, right? Typically. So when the interest rate go up, the floating loans will change, and floating rates will change, and that's where the banks will make the spread from there.
So that's a good point,
Yeah, so I think the banks will definitely benefit a lot from this coming interest rate hike.
That's why if you own a property, if interest rate go up, you tend to pay more in terms of interest rate as well.
Yep. So right here, I have a chart of Interactive Brokers. So I plot a chart against the overnight federal funds rate, right? And you can see, when the overnight federal funds rate went down during the COVID-19 crisis, of course, the stock went down, as with most of the stocks in the stock market. But then now it's at 0.1%, right? The overnight Fed funds rate. But their stocks is above pre-COVID levels, despite revenue being slightly lower. So the idea here is that it does not matter that much, interest rates, but most importantly is we focus on how it will affect the business, and we focus on the valuation. So this following chart, I also plotted against basically their price to book ratio. So their valuation actually of the stock, when we enter and exit a stock like that that's sensitive to economic cycles, we should buy it when it's close to the historical low price to book ratio, the bottom, and sell around the top, because this is basically...
All right. So I want to summarize what Kenny has just been saying. So basically, interest rates will affect certain companies in different ways. So like banks, like Victor was pointing out, interactive brokers, because they have a margin business, they lend money and all that, and they earn net interest income. So that will affect business like that. But your point over here is that, hey, look, don't just focus on that segment of the business. They have other moving parts that are doing pretty well in the case of interactive brokers. And there really is no correlation between the interest rates and how interactive brokers is doing. And they've been doing pretty well over the last, 5-10 years. And interest rates are just a really, really small thing. But I think there are other stocks that could be affected by interest rates. Any other examples?
I have the third category that Kenny mentioned, which is REITs, real estate investment trust, right? So I think this is an instrument where, every time when the Fed announced that they're going to increase the interest rate, the REITs prices will drop across the board, right? So generally what Kenny is basically saying is that, if you come across a good REITs that you want to own in your portfolio, that is actually the best time to look at them, because if you look at REITs, even though they are loans, because by nature REITs generally they take on a lot of loans, right, to buy those commercial property and then hold it, and generally they don't pay it down, they just keep rolling on the debt. So if interest rate to go up, the interest on loans will also go up, and they may, theoretically speaking, they will pay lesser distribution, right? But in practical terms, and then generally if the economy is doing well, interest rates start to go up, people are earning more. So when people are earning more, they are spending more, and when people are spending more, let's say a retail REITs, for example, they can actually afford to raise the rent. And by raising the rent, they can actually collect more rental income, and they pay down higher interest rate. It's no problem to them, and they can actually afford to increase the distribution per unit. And this happened in the early 2004 all the way to 2007 when the interest rate was rising to as high as I think 5%. REITs were still paying increasing distribution per unit back then. Of course, time has changed. COVID has changed certain industry on how people actually use the property. But put that aside, I think generally REITs will do fine if the interest rate were to rise gradually to 2%, 3%, 4%. But there's a certain benchmark. Once it crosses above that, it will be very difficult for them to continue to it will be very difficult for them to continue to increase the rental rate, because tenants will be.
Do you listen
unhappy
to some kind of REIT music on Spotify? It's like, why would they come in? But so basically the point you're making is that interest rates will go up. The loans for REITs, because REITs are naturally they borrow for their properties and all that, their costs will go up. Right. So that's a given. But the well-managed REITs that have good properties, the high occupancy rates, they will still do well. Because of the economic activity that usually comes with higher interest rates. Right. There's people shopping and offices are doing well and all that stuff. So REITs are another thing that probably someone who has a lot of REITs will want to look at.
But I have to say that, strong caveat, if the interest rate were to go up to as high as like 6, 7, 8%, I think the REITs in Singapore are not tested yet, because the first REITs was listed in 2003, so we do not know how they're going to perform. I think it will not be so good for them because the loans is too expensive to borrow, right? But when would that happen? I don't think it's going to happen in the next 2 years, 3 years, right? It probably takes some time before they will increase the interest rate to that kind of level, right?
And I think a lot of REITs, right, they tend to hedge on they tend to fix on the loan, right? So once the loan is fixed, usually they fix for quite some time. So before, maybe by the time the loan end, the interest rate has fallen.
So there are strategies that we can like look at their loans and make sure most of them are fixed. You can invest in those type of REITs, right? CapitaLand, commercial trust are those REITs that typically they hedge their interest rate, the loans very long.
Integrated commercial
trust. So that will give them some time to buffer for the sudden higher interest rate.
I think a good REIT is managed that way. They actually have that what do you call it, maturity planned out and everything.
I think they're built to fight the interest rate.
I think if you have a good manager, they should be thinking about all these things, because interest rates are, I think, on top of their minds. So interest rates will affect stocks differently. So like banks probably do well, REITs, costs will go up. So you need to make sure that they kind of handle that. And then are there any stocks that kind of like don't do so well if the interest rates go up,
I think those companies with very high borrowings, they tend to don't do well during the very high interest rate, because if they are very heavily in debt and they have those business where they can't immediately pass down the price, right? So it could definitely go to hurt their margin. So for instance, like companies like those manufacturing business, usually when they manufacture for their customers, they tend to have let's say example the packaging industry, right? They tend to have pass down a contract with the customers.
Yep.
Okay, so when the let's say the costs start to go up and they borrow, to buy their raw material and all this, and because of the inflation very high, so they cannot immediately pass it down, right? So they need to wait another 1 year or two before they can
Because
pass
they
it
really
down.
locked in the contract with their client, right?
Right.
They can't just change the price straight away.
Correct.
Yeah.
So it really depends. But of course, if those packaging business do not are not heavily in debt, they don't borrow to buy their raw material, then there's no problem. Okay, but if they are heavily in debt, they borrow to run their business. Then when the interest rate go up, it's really a double whelming, because the increase in the commodity price, which is the inflation, which will hurt them. Second, the interest rate increase will hurt their bottom line. Yeah.
So I think in general, interest rates will affect, different ways, different companies and all that. But I think in general, the point is, if a company, I mean, that's not just in manufacturing, if a company has very high debt, interest rates are going to be a big thing, right? Because it's going to get more expensive, and they might not be able to pay it off.
Yeah, in the case of Hyflux, I think this is one of the good example where the companies couldn't, they just have a poor business.
Yeah, correct.
And then they have so much debt in their portfolio. Yeah. And because interest have to go up and the business is not coming in, cash flow is not coming in, then in the end they got liquidity issue. Yeah. So in the end they have to file for bankruptcy. Yeah. Okay, so generally I think if the best strategy is to counter this high of interest rate in the future, right? If you don't want to worry, just look for those companies that have relatively low debt. Okay, that's one. And second, of course, look for those companies that are like compounders, which I think Kenny mentioned. Generally, those companies have a very strong pricing power, right? And they will continue to perform well regardless of the interest rate, right? Because
which is actually my next question, which is how would you deal with rising interest rates? So I think there are people out there who may own a lot of REITs because they love the passive income, but they're worried about interest rates. Maybe they own the banks, right, in Singapore or where else, and then maybe they own some of the stocks that we mentioned here and there, or they own something that has a lot of debt on their balance sheet, and they're worried about that. So let's say interest rates go up. I think 1 to 3%. All right. You would think maybe, but let's say it goes higher. What is your personal strategy to deal with rising interest rates? If things really go a little bit more, expensive, how would you deal with that? What is your strategy when it comes to your portfolio?
I think you just invest in those consumer products, because they are able to pass down the cost. So when the interest rate rise, there's not much of an issue. And of course, you can look into the banks, right? Like we say, the banks will perform well during the high interest rate. And moving forward, the probability of increasing is much higher than it will stay low for the next 10 years, right?
Yeah, and another one, of course, generally people will avoid REITs because of the rising interest rate environment. But usually we take that kind of opportunity, when there's a fear in the market, REITs prices have to drop. It will actually make more sense to invest in REITs and not selectively pick those REITs that are not overly average. They have a lot of their loans are fixed for a long time, and stick to those REITs. And generally, I think I've been using this strategy for the last 10 years. 2015 there was a fear of interest rate hike, and a lot of REITs were sold down 20-30% just within a month.
So for you, it's actually an opportunity.
It was an opportunity because the yield was too tempting, right? And it justified that kind of investment. Yeah. So sometimes you can take advantage on this kind of panic selling. Okay, so
with the caveat that you do a due diligence and you pick the right kind of REIT, because there are REITs that we basically don't do so well because they're not managed well.
That's
so you got to pick the high quality ones. And what about you, Kenny? How would you deal with the rising interest rates?
For me, it's like I'll just focus on compounders. So so first thing, I just let the chart speak for itself, right? First thing, I also plot against the overnight Fed funds rate about the companies that we talked about in the previous video, right? Compounders, right? Basically Amazon, Adobe, and MasterCard. So these are the companies you can see, despite the interest rate go up and down for the past 5 to 10 years, it has been growing up or going up. Of course, not in a linear fashion, but I mean up and down, but up eventually. So for companies like MasterCard, I think most of the inflation will be baked into the dollars that pass through their network. So one good example is, of course, if the cost were to go up, all these manufacturers will increase the price of their products, sell on to the retailers. Retailers will increase the price and pass on down to their consumers. So generally, this will be inflation-proof. Amazon too, as they sell through Amazon, the prices are all big in there, and Amazon gets a cut of their business. And Adobe at the same time, if they can raise prices, and eventually maybe the movies and all the stuff that we can't be in touch with will also increase in prices. So these are most likely companies that are able to raise prices when it comes to inflation, because at the end of the day, we're not worried about interest rate rise, but more like inflation. So I've taken a look at the CPI index. So the past 5 years, the past 10 years actually, it went up by 19%, which on average. I also look at the 3-year and the 5-year as well. It hovers around 2%, the target that the Fed has set for themselves. So in the long run, it's around 2% for them. So that's why if you keep a lot of money in your bank, your purchasing power will basically erode over time, because the bank pays you below 1%, right? And then you look at all these compounders that we talk about, right? Adobe went up by 1,890%, Amazon 1,660%, and then Mastercard 1,140%. So that's the reason why I say I let the chart speak for itself. You pick compounders, you can just close your eyes and wake up like 5 years later and you'll be okay.
So basically, whatever happens, inflation or interest rates going up, pick the great companies that can pass on their cost to consumers. They pass on the price down the pricing power is all that.
Yeah.
I mean, they have pricing power, they pass down the cost, and pick the really good companies. That would be your strategy.
Yeah.
Yep. So I think just to sum up, I think the takeaway is that don't worry so much about interest rates per se, but really what you're investing in your portfolio. So you want to look out for companies with high amounts of debt, because that could be a little bit risky if it goes up. But in general, if a company is good, it's high quality, they have pricing power, they'll be able to pass on that the cost to the consumers, and still perform really well over the long term. And in terms of the REITs, you said is a great opportunity to have a look at that as well, as long as they're managed well. Yep. So I think that's pretty much what you guys have discussed over this entire roundtable, right?
Yep.
All right. So I hope you learned something about that. Don't worry so much about interest rates. What's going to go up. It's over the long term is really what you invest in your portfolio. So I really hope this roundtable helped you out. I hope you learned something. So once again, my name is Adam. This is Victor.
Thank you.
Kenny.
Thank you.
If you like our content, please hit the like button to tell us that we're doing a good job. And of course, subscribe to our content. We have many more roundtables coming up as well. Any questions or discussions about this video, feel free to put them in a comment box and we'll have a conversation with you as well. So once again, thank you for watching and we'll see you around again.